there is actually a passive factor that we've been able to isolate, and it appears to be the single most important factor that exists in the market today. My passive factor would suggest that about 1,200 basis points of the return that we've experienced out of passive equities over the last decade can be tied to that passive factor. I can't possibly know all the permutations of how this will ultimately play out, but it does really seem that a lot of this is going to continue until either valuations get so extreme to the top side that we basically start to sell simply because we've accumulated so many assets that we all decide that we can live fantastically rich forever, or we change policy in one form or another, right? It's the same phenomenon, unfortunately, that played out with the XIV. It's going to keep going up until a volatile enough event occurs to break it.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. When you're uncertain, they say to seek the counsel of those smarter than you. Well, amongst the many experts I interview on this channel, Mike Green is definitely in the top cohort intellectual horsepower-wise. Mike's portfolio manager and chief strategist at Simplify Asset Management, which holds over $6 billion in client assets. And today, we'll tap his latest thinking on the stock market, the credit market, the economy, and whatever else 2026 holds for investors that he thinks important. Mike, thanks so much for joining us today.
It's a pleasure to be here. Thank you for having me back, Adam. I do have to point out, actually, we're almost 12 billion in assets now, actually.
All right. Well, look, I'm just going to update the intro there. I must have been taking it out. Is one of your bios, so you got to update your bio.
Yep.
That's very impressive, though. All right, over 12 billion in assets. All right. Lots to talk about. It's been a while since you've been on. I am going to ask you about the giant mindless robot, but I'll try to be novel and not start with that. You've recently written at length about your concerns about private equity. In addition to that, we've been starting to see cockroach companies causing trouble in the private credit space as well. So I guess let's start here. How concerned are you about these more opaque but very fast-growing private markets?
Well, I think the obvious component about the private markets is simply that because they have not had to mark to a public market level, they've been able to conceal the deterioration in returns that's happening within the private space. There's been an unbelievable flood of capital that has come into private equity and private credit. Private equity in particular has been unable to obtain the types of liquidity events that allow them to return capital to investors. At the same time, they continue to claim extraordinary performance in the marking, the pricing that they're putting on their security positions.
Right. So sort of a just trust me, bro kind of pricing.
Yeah, I mean, I don't know if I'd add the bro. I think that degrades the degree of seriousness which they try to present these marks. But they very much have an issue where at the core of private equity is a levered operating company. Those levered operating companies are dealing broadly with an economic slowdown. Very few of the private equity investments are in the rapidly growing AI or data center type spaces, although they are looking to, particularly in private credit, lend to those areas, which of course opens up its own area of concern. If we look at publicly traded equities that are levered similarly to private equity assets with a similar industrial mix, bias towards older economy, et cetera, those have been down a cumulative 6% over the last 5 years. Private equity claims that its holdings are up 116% over that time period. There is no amount of leverage that you can apply to get from -6 to +115. So it suggests to me that the collateral that underpins much of private equity, the actual value of the assets, is well below where it is suggested to be. Unfortunately, that's matched by declining distributions, meaning that they have not been able to return cash as their valuations have supposedly increased. That suggests that the simplest conclusion is they're just not accurate or they're lying about the performance. Most Americans shouldn't care about this until it makes its way into either the labor market because of the failure of many private equity entities. We actually just saw a home renovation business that was shut down instantaneously, going for a Chapter 7 liquidation people lose their jobs when that happens. And those bonds were marked at par just a month ago. Today, they're being written off entirely. Um, it also suggests that much of the private credit space, which has by and large been the source of lending into the private equity space, has assets that are worth far less than they think they are, or at least that they are indicating that they are. I don't want to overly alarm people, but these are the sorts of things that we saw developing in the housing market, in particular the housing finance market in 2007 and in 2008. Um, you know, private assets and public assets are ultimately the same thing. It's just held by different parties. And the
Mhm.
law of one price says that it's not possible for the performance to be as different as they are. And that just suggests to me, as I've indicated in many other areas, that there's less value there than people think. And you add leverage to less value, it becomes very concerning. But for most investors, they don't have a ton of exposure to private equity. So why does it matter all that much? I'm not entirely sure that it does to most Americans until they're forced to invest their 401ks into private assets, which has still not yet happened.
So, sorry to interrupt, that hasn't happened, but a lot of pensions have increased their holdings of private equity. So that will matter to those folks, right?
Yeah, I mean, I think you got to be very careful, right? Remember, at the end of the day, three-quarters of the private pension space, the defined benefit space, is now federal and public, state and local employees. I hate to be so crass, but they'll just get bailed out, right? The taxpayer will pay for it. That's really the game that's being played.
Okay. But I mean, I would think that's something that the average taxpayer may still want to know about.
Oh, they absolutely should know about it. I'm just saying, in terms of your individual wealth, my guess is not much of the audience has huge allocations to private credit or private equity, at least yet.
Yeah. Well, okay. So you could say, all right, this is kind of a rich person's problem, but how about, you know, I know you said you weren't trying to be alarmist, but you said this is not dissimilar to what was going on in the subprime loans up to 2008. Um, could this, Jamie Dimon said cockroaches, right? If you see one, you see more. If indeed the collateral just isn't anywhere near what is thought to be right now, and that starts getting discovered, is there potential for sort of a cascading effect like we had in 2028 where, lenders just get more and more nervous about what's going on and they constrain lending and you've got, all of a sudden nobody's willing to lend to one another and you get kind of a credit contagion like we had in 2008?
I think there is some. I think there are critical risks associated primarily with credit spread widening and a tightening of financial conditions associated with uncertainty as to the value of these assets. Remember that you discover cockroaches when you turn the light on in the kitchen, when you walk into it. If you see one cockroach, part of the issue is you start looking for them, right?
Hmm.
And that's really what's happening in the banking system right now. This is that both the banking system and many limited partners in private credit funds, et cetera, are suddenly demanding a higher level of due diligence. And it's when that happens that you discover that there are frauds or that there's improper collateral or that covenants aren't as strong as you thought they were, et cetera. And as those periods of distress rise, you start to see an increase in what's called creditor on creditor violence, meaning people basically start fighting over the pieces that are left over to try to secure their claims. In that type of framework, you start seeing less club deals, you start seeing less coordination, which means there is less absolute financing that's available. And that can have an economic effect. It also has a high propensity in this type of environment to uncover yet more frauds. The lights on in the kitchen, we're looking behind the sink and we're looking behind the oven, et cetera, to see where the cockroaches might actually be. Whereas before we were kind of just blithely unaware.
Okay. So just to bring this down to brass tacks, in terms of you losing sleep over this, if one is a perfect night's slumber, 10 is you're not sleeping a wink, where are you right now?
I rarely don't sleep, so I don't sleep great. But all of these things are ultimately market mechanisms. The real challenge becomes: do we allow the market to actually clear in these results? And my hunch is, unfortunately, that that will likely see various forms of intervention to prevent the change of control features spreading broadly in a cascading environment. The offset to that is that we don't necessarily have a coherent government philosophy at this point in terms of what are we supposed to do about bailouts, right? We've heard everything ranging from AI asking for pre-bailouts and guarantees of debt.
Right.
We have absolutely no idea how the Trump administration is going to respond, and that for me is ultimately the much more concerning component.
Okay. And in terms of the mechanisms of the bailout for private credit, at least, because it's not coming from the banking system, would that have to come from the administration side, or would the Fed get involved?
Uh, my hunch is that the first stop would be the Fed, although the Fed itself likely sees itself as relatively constrained by inflation at this point. I think that's one of the things that is kept the response from being more aggressive. If it shows up in employment, if it shows up in market correction in any way, shape, or form, it's just really hard to imagine the Fed standing by and not moving relatively aggressively.
Okay.
Like
Do we?
I want to get worried about this because I think it's actually a really big deal.
Yeah.
But at the same time, we're just in an environment in which it feels like the next step will be some form of a bailout, some
Right.
form of credit guarantees, something to prevent the change of control, which is really the unique feature to credit instruments. They have embedded in them a change of control feature that says, you didn't do a good job of managing this. Now it's mine, right?
Hmm.
And you discover how perfected your claims are in this process. You discover what the actual cost of capital is for, restoring some semblance of sanity to a capital structure. But it's really hard to do in an environment in which the government is incentivized to continually step in.
Hmm. And you're right. We have been in a bailout first, ask questions later environment
Mhm.
for a good long while right now. I'm curious, do you see the new administration as being any more or less sympathetic to that? And you mentioned, AI, open AI kind of floating the trial balloon for kind of pre-bailout guarantee. And who knows what would happen in the real world, but who was it? Was it Besant who was pretty quick? No, it was David Sachs, the AI czar, who was pretty quick to publicly respond, hey, we're not going to do any bailouts in the AI space. There's plenty of other companies there that can step in if one stumbles. So they're talking a little bit more of letting the free market reign. But is that just words, you think?
Ultimately, I think it's just words, right? Look, AI has managed to get itself bound up in national security issues. It's managed to create a narrative that says the worst possible outcome is China wins in the AI race.
Yep.
The difference between the two approaches between China and the United States, the quantity of data centers are 10x in the United States relative to China. It looks like China is somewhat rationally saying, if there's a race here, it's ultimately going to be won on the basis of efficiency and incremental or significant breakthroughs on this process. We don't see the benefit of running as fast as the Americans are. That may change at some point in the future, but that seems to unfortunately be, where China is on this. In the United States, we've convinced ourselves that this is the mana, right? That this is the future and that we need to invest as aggressively as we possibly can,
Hmm.
with very little prospect of immediate returns to it, right? I think many of us, I personally am experiencing an incredible degradation in OpenAI's performance. It's becoming increasingly unuseful for me. Exactly to David Sachs' point, there's lots of other AI tools, LLM tools that have risen to take some of that capability and substitute so that I'm not totally starved. But it's very hard for me to imagine a continuing relationship with OpenAI as it exists today. And that in turn then raises big questions about what does this whole space look like in the face of somebody with the type of capacity that OpenAI had if they fail, right? Suddenly, tons of Microsoft Azure is open for utilization, which would damage
Hmm.
Microsoft, right? This pattern flows through on a continuous basis. I think it's a lot easier to say we're going to be focused on free market solutions than it is to actually follow through on that when the reality presents itself. Right? George Bush famously said, I had to break the system to save the system, right?
Right.
It strikes me as very hard to imagine a Trump administration allowing a significant downgrade to GDP or employment because this spending suddenly dries
Right.
up.
or the stock market, which continues to be this administration's favorite scorecard.
Correct.
Okay, so let's fully step into the AI space now then. So maybe I'm just going to the punchline here, but um, how likely is it, do you think, that there will be a material downward repricing of AI equities, because just as we've had with all other kind of scrambles to build out new transformative infrastructure, we overbuild, we get all hyped up on what the new potential is, but then as we really begin to see how things are going, we realize, okay, this very well may create the wealth we think it's going to, or the prosperity we think it's going to, but it's probably going to be on a longer timeline than what we got all excited about, just like we had with the dot-com bust, for example. How inevitable, if at all, do you think that is here?
Well, I think it's a pretty high probability, right? The similarities between what is happening in the LLM build out and the data center build out and what transpired in the dot-com cycle are extraordinarily high, right? And so people will try to point to the dot-com cycle and say, oh, well, it was all about unprofitable companies. No, Microsoft and Cisco were extraordinarily profitable companies. Yes, the companies that were building out the infrastructure were unprofitable as they were building it out. Many of the ISPs were marginally profitable, but they had the ability to access tons of capital under the promise that there was going to be extraordinary revenue growth in the space. Ironically, what ended up happening was because of the increase in capacity and because of the innovative attempts to improve the infrastructure that was already in place, in particular what was called wave division multiplexing and then amplification technologies along the fiber itself, we discovered that we didn't actually increase revenues. We decreased revenues by about 50% in the telecom space, even as capacity exploded about 1,000x, right?
Hmm.
It's very hard to imagine a world in which we have an infinitely productive, AI, personal AI that we have access to, and somehow or another we can't figure out how to do it more productively than we could, before we had those tools. That just strikes me as somewhat absurd, right? More and more people are focused on this. There's greater and greater rewards in terms of the price umbrella that's created by the old technology for coming up with more efficient solutions to it. It just strikes me that ultimately this is going to end up very much like internet search, where it's ultimately advertising supported, and in exchange, I get a much, much, much more powerful version of search that can help me do all sorts of things that search currently can't do. Search can allow me to get information. It can't allow me, it doesn't facilitate me compiling it, right? It doesn't facilitate analyzing that data. An
Right. Or
LLM
the
can do
agentic part
that.
of it too, taking action
Or
based on the data. The agentic part, like, okay, you gave me an answer, now go book me that flight.
yes.
Now go, right? Yeah.
Yeah, and I mean we've tried doing components of that, right? I mean things like Google Flights are very, very close to a centralized architecture for booking and checking flights. It's the first place I go to, right? Would it be better if I was able to say to an LLM, similar to how I say to my assistant, I have to be in Houston at 3 p.m. on Tuesday. What's the most efficient routing given the rest of my schedule, right? It's very hard to imagine that that's not going to be automated. But that is a very minor improvement relative to the type of improvement that can occur when it's easier for me to do my job better, right?
Hmm.
It's easier for the LLM to become increasingly specialized in my area of domain expertise, which in turn makes it, the equivalent of moving from a first-year analyst to a third-year analyst to a senior PM, right? These are all things that I expect will happen as we move forward on this. But at every step in this process, it's going to be a cyborg type component, a blending of machine and man that will ultimately drive this. And again, it just strikes me as so painfully obviously deflationary in its underlying construction.
Okay. Can I ask you this? Well, actually, sorry, let me follow up on that last point you just made. So, I think you said painfully deflationary. Um, so another way to perhaps interpret that is the pile of profits just might not be as large coming out of all this as people are dreaming of right now. Um, do you think that statement is true, at least in the near term?
Yeah, I mean, I think the really critical thing to understand is that there is no pile of profits currently, right? There's a pile of extraordinary losses that are being propped up by
Hmm.
investments into these firms. This is generating intense consumer surplus, whether, and that's measured by the amount of losses that are being generated by these companies. What fraction of that surplus is currently being shared with NVIDIA, for example, or Broadcom, is the part that is ultimately really up for debate on this. Will these productivity gains make these systems so much better that we absolutely can't survive without them, right? We'd be willing to sacrifice water and food in order to gain access to these LLMs. It just strikes me as that's a somewhat absurd conclusion. And so it's likely to move itself to the point that the vast majority of people just gravitate to the lowest possible cost option of accessing these types of tools, which is always going to be the advertising supported model.
Yep, they're free. Yeah, free
Right.
ad supported. Yep. Okay, so well then let's just pursue this to its which you think is the likeliest denouement, which is there's a pretty substantial repricing of these assets. Just walk me through what that looks like in terms of its impact on these stocks, on the markets, on the economy, as a lot of these companies probably then have to, start downsizing, and a lot of people feeding off the AI ecosystem have to downshift as well.
Well,
Sorry,
I think you
and a lot of people who have, the folks who have
significant
money who've been
investments. Yeah.
enjoying this ride all of a sudden have a negative wealth effect, right? Yeah.
Yeah. I mean, here's the challenge, right? It ultimately has to translate into flows, cash flows, incomes, et cetera. And so, to the extent that the problems that we're identifying ultimately mean that the revenues of Microsoft or the revenues of OpenAI or the revenues of privately held
NVIDIA.
X, et cetera, or NVIDIA fail to materialize, right? The link between that and stock prices is ultimately a very tenuous one, right?
Hmm.
Who ultimately decides that they're going to sell NVIDIA in enough size that it's going to offset the contributions that are coming in through things like 401ks? Well, there's just not that much active holding of NVIDIA anymore, right? On the margin, can it have a big impact if everybody suddenly woke up tomorrow and said, gosh, I have to dump my NVIDIA stock, right? Obviously, that is a very big negative. It would cause prices to correct quite sharply. Those corrected prices would then almost instantaneously be assumed to be correct by the giant mindless robot of passive investing, and it would receive capital, but in reduced form, right? And so where that stops is pretty hard to articulate. It really does boil down to, do people see that experience? Do they go through that sharp correction in which NVIDIA falls as it did in 2022 and suddenly start deciding, oh, this S&P thing's not for me anymore, or this total market fund is not for me, right? I'm out.
Hmm.
It's just really hard to imagine that happening right now, Adam. Like,
So I
unless
know it's hard to imagine that happening right now, but I guess my question for you, Mike, is could we go through this downward repricing of the AI sector like the dot-com sector went through when that bubble finally reached its zenith? And could that happen and yet the passive bid still be positive?
The unfortunate answer is yes, right? I mean, there's a variety of ways that we're moving that continues to emphasize putting more and more money into equities. Um, One example is the Trump accounts, right? Effectively 529s from birth that extend
Hmm.
through life, right?
Yeah, I remember we were
Uh,
chatting about that a while ago. Yeah.
that is one tool to drive even more funds into a market that is shrinking in the number of targets. Another mechanism would be to turn around and say that the government is going to start buying these assets, right? Another mechanism is that we, extend the age of retirement. I actually would painfully point out that the 50-year mortgage can be best interpreted as a mechanism to get people to delay their retirements because they won't have paid off their mortgages when they hit 70, and therefore they probably won't be able to retire in the way
Yeah.
that people historically have, right? That means that the burden on Social Security and Medicare is less than you would otherwise think it would be, right? It's putting more burden back onto the private sector. I, I can't possibly know all the permutations of how this will ultimately play out, but it does really seem that a lot of this is going to continue until either valuations get so extreme to the top side that we basically start to sell simply because we've accumulated so many assets that we all decide that we can live fantastically rich forever, or we change policy in one form or another, right? It's the same phenomenon, unfortunately, that played out with the XIV. It's going to keep going up until a volatile enough event occurs to break it.
Okay. So this is not that dissimilar to, you know, both monetary and fiscal policy, where you keep getting away with what you can get away with until inflation rears its ugly head, right? So, we had to change our policies finally when inflation really took off. Um, so I don't see the current administration nor the previous one or what's likely to be the next one to proactively change policy to avoid this. I think they'll probably continue to be more bailouty and interventionary, for some of the reasons we've already talked about. Um, so it kind of does make just a powerful argument to just learn to love the passive robot. just and just ride that sucker until something breaks.
Yeah, unfortunately, I mean, that's the direction that it looks like it goes. And again, there are things that can cause it to break, and there are components to it. If valuations get high enough, as I've emphasized repeatedly,
Right. If,
withdrawals
if
are always a function of asset values.
right. If unemployment
Contributions,
gets large enough, right?
if unemployment gets large enough, right? If we decide that we're going to change our policy, but literally everything that we're doing, I mean, even look at the arguments to incorporate alternative assets into 401ks and target date funds, right? What are they talking about doing? Reducing the bond component of the portfolio,
Hmm.
not necessarily reducing the equity component of the portfolio, right? When you consider that venture and private equity are basically 1.6 and somewhere in the neighborhood of 2.5 beta instruments, taking 20% of your 60/40 portfolio that was in bonds and putting it, so going to a 60/20/20 where your 20 is now sent into alternative assets, quote unquote, private assets, that's a dramatic increase in equity exposure, right? I mean, it's just a giant increase in equity exposure if you beta adjust those types of
Right.
exposures. And
Because you're
so
adding private equity now to public.
you're adding private equity to public instead of replacing public equity with private equity, right? So the details on how these are incorporated and how we choose to change our portfolios are going to have a huge impact on the performance that we should expect to see. But I would just argue that one of the areas that I'm increasingly focused on is isolating effectively the passive factor, right? So you think about the size factor or the value factor or quality factor, et cetera. There is actually a passive factor that we've been able to isolate, and it appears to be the single most important factor that exists in the market today.
Okay. And what is that factor telling you? Clear sailing?
Well, what it says right now is that a stock like Apple appears to have about a 20% endogenous return associated with the flow of assets from passive, and that's accelerating because of Apple's weight in the index. It's getting larger and larger fractions of larger and larger flows as a proportion of the total flow component. It's just very, very hard to fight against that.
And I don't think that's unique to Apple, right? I'm guessing that's shared by everything that benefits from current passive flows.
Yeah, I mean, this is part of where the research is increasingly focuses the idea on isolating that passive factor, determining it on each individual security. Perversely, that's actually easier than figuring out when the flows are going to change, right?
Sure.
So it's a question of can we optimize given the flows and the assumption that they're in there. Like there appear to be ways to do this that I'm very actively exploring. I will be very candid. Like I don't like it, right? I
Yeah,
think it's
I know you
actually
don't.
quite corrosive. But the simple reality is I have a fiduciary obligation to my investors to explore every opportunity I have to make money for them.
Sure. So where I was going with that question is you said that the passive flow, sorry, the passive factor for Apple was substantial, material, and increasing. Is
Yes.
it, and I know it's to different effects on different assets, what their passive factor is, but collectively for the market, can we make the same statement that the passive factor for the overall market is substantial, significant, material, and growing?
Increasing. Yes, unfortunately we can. As concentration grows, there are some changes in terms of the impact that it has on particular stocks, but this does appear to be driving this divergence that we've seen where the size factor has become very large. The size factor is a close facsimile, but it's not exactly related to the passive factor. There's some wrinkles around that change it slightly, so it is independent but correlated. And this does appear to be what's driving the markets, right? And it is substantial. I mean, if we go back a decade ago, all the forecasts that came from traditional forecasting methodologies would have told you negative expected returns to large cap US equities. My passive factor would suggest that about 1,200 basis points of the return that we've experienced out of passive equities over the last decade can be tied to that passive factor.
Okay, so I just issued like an hour before we got on here, Mike, an interview I just recorded with one of the asset managers at GMO, at Jeremy Grantham's firm, and they, over the next 7 years, on a real return basis, they expect value stocks, particularly international value stocks, to do quite well, and they're forecasting U.S. growth stocks to probably perform the worst in terms of their annual average real returns going forward. And I guess you would say, for that to be right, something has to change with that passive factor.
Yeah, I mean, I would go back and point out that the exact same claim was made in 2016 by GMO, right?
Sure.
And the core of what I would argue GMO is missing, and it's somewhat ironic, and I have to confess, like I'm a Jeremy Grantham fanboy. I was a huge proponent of his type of analysis going into the dot-com cycle. What has happened is that they are looking back at the history of returns and effectively saying that this is an aberrant period. And the assumption is that the aberrant period will correct itself,
Right.
right? It's a mean reversion forecast. The work that I've done around passive and the component of passive, in physics, you would think of it as a loading factor, right? The natural state for water is to cool itself down to roughly room temperature. But if you put that water into a pot and you put it on a stove and you apply a forcing factor, a loading factor to it, we call heat, right? It will continue to heat until it hits a phase change and turns into water vapor. There's no mean reversion, right? Because I've added an additional
Right.
factor versus something that wasn't there before.
Yeah.
And that's where I would argue that they have been mistaken in their forecasts. It's what's somewhat unique about my articulation of things is that we have introduced a mechanism of investing that causes very predictable impacts at the single stock and index level. And those, unfortunately, have been very close to what's played out empirically over that time period. Most of my forecasts, as you know, were made in the 2016 to 2017 time period. And unfortunately, it's really played out very much as my data, my analysis would have suggested.
Okay. So yeah, and look, I wasn't necessarily trying to engineer a debate between you and
Oh,
GMO, but I think,
yeah. I mean, look, I will be very straightforward. I have tremendous respect for the way that they approach it. And actually, you know what? I'm going to share a slide here. Give me two
all right,
seconds. Share a slide.
that's fine. It's fine. I'm glad I actually asked it because I think your analogy there with the water and the stove is actually really instructive. So I'll let you pull up your data here, and then I'll ask you one more leading question on this.
So, what was unique in the work that I did back in 2016 was I actually asked the question, why do markets behave the way that Jeremy Grantham has articulated, and why have they behaved this way in the past? And I was really surprised to discover that there weren't actually good models of how managers, active discretionary managers, reacted to valuation. We knew that a Shiller PE exhibited mean reverting characteristics, but we didn't know why, right? And so my research, I went out and I surveyed investors and I asked them a fairly straightforward question. You're a portfolio manager, you have 5% cash in your portfolio, so cash is not an immediate constraint. You receive a 1% inflow or a redemption request. How do you respond in the presence of valuations? And so on the x-axis here, we see a valuation. I specified it was a Shiller type valuation. And on the y-axis, we have the marginal propensity. The marginal propensity to sell rises as valuations rise. The marginal propensity to buy falls as valuations rise. That's somewhat unsurprising, right? If you engage in discounting, if you
Sure.
understand a discounted cash flow model, a higher valuation, all else equal, lowers your forward returns, makes you more willing to sell, less willing to buy. The intersection of these two lines, which again is just a sample of 450 investors, they crossed at almost 50-50 at exactly the market's historical valuation average. And this makes sense if you then take those responses, feed them into an agentic model, right? Something we've talked about with LLMs, and that you can do this yourself if you'd like to, and randomly fed them cash and took cash away. And what we discovered is that you'd get a mean reverting market from these behaviors. When you introduce passive vehicles, what you've actually done is introduce an entity with 100% propensity to buy or sell. And so that changes the structure of the market as they grow in share. By the time you get to roughly where we are today at 50% passive, you've shifted away from that mean reverting market into what's called a mean expansionary market. As money flows into passive, they continue to buy. That creates the orange line as compared to the blue line. So instead of mean reversion, you get mean expansion. It's just a physical system into which we have done the equivalent of put it on a stove.
Yeah. And so the stove heat, I'm going to probably murder your analogy,
That's
but
okay.
it trumps, it wins out over a whole host of other um, previous factors. Oh, we might put some salt into the water and that changes its boiling temperature. Oh, we might throw a couple of ice cubes in there and we would normally expect it to get colder. But if this thing's sitting on the stove, it's still being driven higher to a boiling point over time. And kind of where I'm going with this is what I'm kind of taking away from what you're saying, Mike, is like, you know, if you find this confusing, you almost don't even have to understand it. It's almost like the people who are just like, I'm gonna, money printer go burr. Like just there's just a force out there that is the dominant one. And until that changes, almost nothing else matters. So just be along the passive flows and just ride it. Because if you're waiting for a mean reversion, if you're waiting for some cycle that is manifested many times, over the past 100 years, it very well may not manifest this time, at least up until the point that the passive flow gets compromised in some way.
Yeah, that is unfortunately the conclusion that comes out of it. And almost all the reaction functions, right? So let's imagine the Fed cuts interest rates. And, I want to be very, very clear. This actually lends itself to the type of brief crashes that we experienced in February, March, right, of 2025. It also lends itself to exactly what we experienced afterwards. Once that selling is done, it goes right back to the old system. And so if you remember the narrative that existed in February, March, just like the narrative that existed in 2022, 2022 is, oh, interest rates are higher. Now, growth companies should be trading at discounted valuations. Did I lose you? No, okay.
No?
Now growth companies should be trading at discounted valuations because their potential is off into the future. And when you discount that back at a higher interest rate, it lowers their value relative to the value stocks, right? That lasted about 2.5 minutes, right? The March narrative was, oh, American exceptionalism is over. Everybody's going to, chase after Europe, and Europe has figured out fiscal stimulus. They're going to spend money on defense, et cetera, right? Like those are narratives that last for a few weeks until you change the underlying systemic flows. And the systemic flows are increasingly allocated to assets in a target date fund type framework in which the US receives a larger and larger share of global flows. And within those flows, a higher and higher fraction is being received by the largest and most positively affected by passive flow stocks. It's a feedback loop that plays through. I don't see what changes it other than knowing that it does end at some point.
Okay. I almost want to Lego together kind of Brent Johnson's view of the world and your view of the world, which is like more and more capital will continue to flow into the US for reasons you mentioned, and those that follow Brent know all his reasons for that. And then that money that's coming in is going into, a more concentrated version of stocks that will, keep powering things higher. So it's just sort of like just watch the flows. Rest of the world to here to the Mag 7, Mag 10, whatever.
Yeah, and as you go through this, it is catastrophic economically, right? I mean, more and more capital flows into a smaller and smaller group of stocks and to a lesser extent bonds. That reduces the available capital that's there for small business and local
Hmm.
investment. And it ultimately puts us into a situation in which, on a personal basis and on a local community basis, we find ourselves increasingly impoverished, even as our metrics for household wealth grow to all-time highs.
Nice. Yeah. And this then goes to the whole K-shaped economy discussion I've been having an awful lot. Or what I like to say, the lowercase I-shaped economy I'm afraid that we're hurtling towards. And of course, when this breaks, the knee-jerk reaction will be to try to preserve this system, as you were saying earlier, Mike, right?
Right.
Bailouts, whatever it takes to just kind of keep this thing to get back to where it was. All right, so this is a little depressing. So for you as a capital manager, so simplify 12 billion in assets under management. Again, congratulations on that. Um, how do you think about allocating in this environment? Because one could argue, hey, it's just as simple as either own the indices, or it's like just use your models, which companies have the highest passive factor, and let's just shove as much capital as we can into those.
Yeah. I mean, the quick answer is if you have a factor that you've identified that is different from others, there are ways, and you are correct in your analysis. I want to emphasize that, right? Like it's entirely possible that I'm totally out to lunch on this. I don't think I am, and the evidence over the past decade has moved further and further in my favor. But, that can be a little bit like pride goeth before a fall, right?
Hmm.
So, like, I want to be very painfully clear on that. What we're going to find ourselves moving to increasingly is the exploitation phase, where you've identified how a system works and you start the process of exploiting it. At least in the interim, that turns into an accelerant, which causes us to get even crazier, right? We experienced an element of this with retail flows in the past couple of months, where basically the nihilist philosophy took over and said, okay, well, it's obvious what's happening. It's just the government's going to spend like mad and it's depreciation, and therefore I'm going to go buy quantum computing stocks or nuclear power stocks or whatever, right? Those are amplification mechanisms that can push individual areas of the market to extraordinarily high levels on a short-term basis, give people the perception that they're making a ton of money. A really interesting analysis was actually done by a gentleman on Substack looking at the embedded return inside Robinhood accounts. So you can capture this by looking at their filings in terms of what the contributions of AUM have been relative to the performance of the underlying markets. And the great irony, of course, is that the average Robinhood investor, the weighted average Robinhood investor, is actually losing money even in this environment, right? There's just an incredible amount of money that's being burnt in the system. But yes, to the extent that you can identify that type of factor and move it into the exploitation phase, that is the objective. And, morally, it feels disgusting. From a fiduciary standpoint, it's my job.
Okay. So is sort of the elevator sales pitch for Simplify now is we understand the passive factor better than anybody else, so give us your capital and we're going to exploit that.
Well, that I would argue that that is certainly a component of it, right? Some of the products that we run, for example, the high yield product that I run, explicitly include this type of analysis. It has contributed to outperformance. As a firm, our objective is not to exploit the passive factor, but an awareness of it helps us think through how to design products and how to take advantage of it. Again, I reserve the right to be wrong in my analysis. That
Mhm.
would mean that I would probably underperform as compared to outperform.
Yeah. Okay. Um, all right. So let's see where to bring this down. Well, this is normally where I ask about your market outlook, but I kind of feel like we've already kind of put it on the table where you feel like, it's going to go higher until there's some real big material change to these passive flows, obviously with some wiggles along the way. Um, and I normally ask about favorite assets, but I think your favorite assets are the ones that you guys privately calculate as having the best passive factor.
Yeah, I mean, I think that's right. And that is the area of focus that I have at this point is, figuring out the ways to exploit that. Some of it feels almost tongue in cheek, right? Like what you want to buy is what has been working. You want to identify why it's been working. It can't just be about the fundamentals and it can't just be about the passive component. You also have to understand, like, is there something here that's going to change? Is there market pricing that is at odds with what we think it should be, given an awareness of these factors? And I want to emphasize again, like, we're currently in an environment in which most systematic strategies, something we spend a lot of time on at a related company I'm involved with called Tier 1 Alpha, a lot of the systematic positioning strategies like CTAs are fully invested. The volatility control funds are much less invested, but if realized volatility begins to ease off, we'll start to see flows come in there, right? But these are all kind of like that about those wrinkles. And so, I'm just forced into the very uncomfortable position to say, I don't see what's changing this in the short term unless we see a very rapid change in the employment picture. I know everyone points to employment as a lagging indicator, but when the flows are derived from employment, it actually becomes the leading indicator. It's part of the reason why we see stock markets not seem to forecast very forecastable macroeconomic events, because it's all about flows.
All right. Well, Mike, can we make an agreement here that when and if you start seeing a material change to the flows that you think could impact the current trajectory, that after you trade on it, after you let your clients know about it, you then give me a shout and you come on here and let these viewers know about it?
I will absolutely commit to that.
Okay, I very, very much appreciate that. Um, all right, well, look, I want to get to one ending question, just kind of on society, because I know you, like me, Mike, you separate your brain from what you think is likely to happen, given the market and economy we have, versus what you think should happen, given, an American who loves his country and his family and his community. Because oftentimes they're not the same thing. But real quick before I get there, I just want to ask you a question about something that you wrote recently. I didn't fully understand what you meant by it. You said commodities are in a land war with Vanguard and they ain't got any. So
Yeah.
what exactly did you mean by that?
Well, ultimately, commodities need to, in order for commodities to work as an investment thesis, one of two things has to occur. We either have to encounter such incredible shortage that the prices are driven high by industrial demand, or we have to enter into an environment in which investors decide that commodities are undervalued and engage in various strategies to effectively hoard commodities, right? I'm going to buy corn on a commodity exchange, driving up the demand for it with no intention of actually using it. I'm hoarding it in financial form because I think the price is going to rise, i.e. speculation. The problem is that most of the funds that are invested, very, very small sums of it are allocated to commodities. And so you can see a significant shift. But if I look at that giant mindless robot that accounts for about 85% of retirement savings in the United States, things like target date funds, they don't have commodities in them as an asset.
Right, right.
Right. The fantastic period of commodities that we saw in the 2005 to roughly 2012 time period was largely tied to an academic paper that was written by Gary Gorton called Facts and Fantasies of Commodity Futures. It was written in 2005. It created effectively the blessing for commodities as an institutional asset class, drove an unbelievable amount of capital into buying and hoarding commodities. And that's really what you're counting on when you talk about a bid for commodities, is that it's that institutional or retail flow that suddenly decides, wow, uranium is where it's at, forget this NVIDIA stuff. There just aren't the institutional frameworks in terms of allocations that really allow that to happen. That's what I mean by commodities don't have any land in the portfolio.
Okay. I'm gonna make an analogy here. Might be a bad one. But basically, if you're a commodity investor, it's like, how old is LeBron James? Is he like 35?
I think he's 82, something like that. Yeah.
Okay. I'm gonna guess he's 35. I could be way off,
I think he's
but
40. He's got a kid
40?
who's playing in the NBA, right?
Yeah, yeah. Okay. So 40. All right. So if you're a commodity investor, it's like akin to go into a two-on-two basketball match where you're getting randomly paired with a 40-year-old in America, right? Um, and versus somebody who wants to invest your way, Mike, who it's you and LeBron James, right? So it's kind of like, you could ask yourself the question, do I want to be playing the game with some random 40-year-old I get matched with, or do I want LeBron on my team? And essentially, LeBron is the giant mindless robot, right? So if you're choosing not to get the to have the 40 sorry to have the giant mindless robot on your team, it's the equivalent of just playing with some random dude versus LeBron.
Yeah, and I want to be clear, I suck at basketball, right? So if you're pairing me and LeBron James, you still have a chance with a random 40-year-old. But the odds are not in your favor, right?
Yeah,
And
they're highly not in your favor because frankly, you could lie down and LeBron could kill the two of us.
that is actually kind of what I'm encouraging, people to do. It's like, look, there's a fatalism, and it may be a component of, this is the last gasp of it. But part of what has been a real breakthrough for me in the past couple of months as I've been working on this is actually the feedback loop that occurs within the stocks themselves inside the indices. And I'm really, really struggling to find what causes this to break until it is really, really late in the game. And, so I may not totally lay down, but I would suggest that LeBron's going to play at least the first two periods pretty much solo.
Yeah, and I guess what I hear you saying is you don't know when LeBron when he's going to tire out, right? But it wouldn't surprise you if we still had a quarter or more left in the game.
Yeah, unfortunately. I mean, again, the real question is going to boil down to, do we have a meaningful enough economic slowdown to meaningfully impact the flows in a way that changes the character of them? And it's just really hard to see.
Yeah. So what's interesting on this on a personal level is I worked in Silicon Valley for many years. I then lived in Northern California for many more years. I know a lot of people. I have a lot of friends who work and have worked for Google, Apple, a number of these companies. And they have just been wealth printing machines for these
Yeah.
people. I mean, these people haven't, I mean, some of them have been pretty high up, but a number of them have been kind of middle management, whatever. And yet they've done just ferociously well financially because they just have had this perpetual, money printing machine of, oh yeah, I'm getting more options every year, and those just only go up, right? And I don't begrudge them their success, but I'd be lying if I didn't admit to some sort of envy and maybe a little bit of a sense of injustice. Like that's not the way it's supposed to work, right? You're not supposed to just get super rich purely because of the luck of who you decided to work with, right? Now, there is free will and you got to be good to get accepted into these companies and stuff like that. So I'm not saying it's totally random, but I just have seen personally the impact of the giant mindless robot on the people who work for these companies and how it has changed lives for them in a way that 99% of Americans, have watched it by, pass them by. They've been on the team that didn't have LeBron on it.
Yeah. I mean, first I understand both the hesitancy to declare it as envy, right? Because nobody likes to admit to a sin. It is totally understandable, right? And we actually know this. I mean, this was written about by David Autor, I believe, in 2019. The mechanism behind it was identified by Jang at Michigan State a couple of years ago in a paper about the passive impact on the largest companies. I think he misspecified why it's occurring, but it doesn't matter. The simple reality is this is largely unearned. And while many of these people may be good, the simple reality, the analysis was done, last year, that if you had started at NVIDIA as a middle market, as a middle manager, marketer in 2023, making $70,000 a year, your option package would have grown to $10 million. Today, that'd be around $20 million, right? There is absolutely nothing that individual did to deserve that. And it's understandable that the stress that creates for you, among other things, the perception from that individual suddenly that they did deserve it, right? They had the genius to go to work for NVIDIA when they were trying to find other jobs. It's incredibly caustic to society. It's not good, right? It's the equivalent of having a lottery in which, one member of your village wins every year, but it turns out it's the same member, right? That doesn't really bring people together in a meaningful way. And the worst part about it is, in many ways, the behavior from those who have won this game, then turning around and saying, well, somehow or another, I am more deserving than the rest of you. Um, you know, we know the mechanism, we know why it's happening, we know it was a choice that we chose to invest in this way. It appeared rational given what we knew at the time. We know it's not rational today, but getting people to stop something that feels good is hard to do, right? I mean, that's what patent medicines were in the 19th century, right? It's very hard to get people off of opioids. We attempted
Off the laudanum,
prohibition,
yeah.
et cetera, right? These are all very, very hard things to do. They require hard choices. And most importantly, they require acknowledgement on both sides, right? It requires us acknowledging that we shouldn't be envious of their wealth and their good fortune. And at the same time, it requires awareness on their part that they got fantastically lucky. And individuals like Warren Buffett continue to try and reinforce this. You know, his most recent Thanksgiving letter, his recent resignation letter, in which he highlighted, you know, be kind to those who are less fortunate than you.
Right,
Our society almost feels like it's peeling in the opposite direction, right?
right.
The outcry of support for cutting off SNAP benefits and food stamps is extraordinary. This is just silly. It really is.
Well, and personally, I think the sense of injustice or unfairness, um, drives people to react to that. And I think it probably was quite a large factor in the New York City mayoral election, where a lot of younger people have just said, "Look, I don't really care what you're telling me about the evils of socialism. All I know is the current system seems really unfair, so I'm going to try something different." Right?
Yep.
And it's understandable. It's not necessarily desirable, but I mean, sadly, when I kind of project out what's going to happen societally, I see more of that type of desperate decision making going forward, not less, until and unless this system reforms in some material way.
Well, unfortunately, so this is what my latest Substack was largely about, right? It was called Mispriced Hope, and it
Hmm.
was identifying effectively that the American dream can be thought of as an option on advancement. For citizens of New York City, they're increasingly looking at that option as unexercisable, right?
Hmm.
The cost of living there is too high. The cost of obtaining the jobs that would allow them to advance in New York are too high. And most of those who are very successful in New York have some form of attitude that says, well, if you try to take anything back or reduce my income, I'm going to leave, right? Well, at some point, you call the bluff.
Yeah, which I just did down in California in my own life.
You did it in California, but that was calling the bluff from the perspective of the successful individual who said, I'm no longer subsidizing this, right? We
Yep.
actually just saw the opposite, where Ricky Sandler of Eminence Capital, and I'm not picking on Ricky and I'm not, blaming him for his choices, but, he had announced, well, I'm going to leave and I'm going to take my company with me if Mandami wins. Mandami wins. Well, I mean, I'll stay for now,
Yeah.
right? Um, okay.
All right. Well, look, I hope I didn't bring too many people down in this discussion. Mike,
It
I'm
wasn't you. You were actually great. I was just, my normal, really depressing self with a touch of nihilism thrown in for added measure this time.
Well, Mike, I mean, I know you enough to know where your heart is, and I believe, and you correct me if this is an incorrect belief, but I believe that you think in the long run, things will equilibrate, but who knows how long the long run could be. I mean, it could be till we're old men or gone.
Yeah, I mean, unfortunately, I think it is likely that I will be an old man before this is gone, but I am incredibly hopeful about humanity. I'm incredibly hopeful about the younger generation. I think they've seen many of the mistakes that we've made. And candidly, I think things like Mandami, who will ultimately probably prove incredibly ineffectual in New York, are part of that same process that you go through as a young person,
Right.
your teens and early 20s, where you embrace forms of nihilism and say, none of it matters, and I'm just going to die. And I mean, we all have had, or at least I have had teenage sons, where I go into their bedroom at night and they can't fall asleep because, oh my God, I'm going to die in 70 years. So what's the point, et cetera. The reality is that this is an incredible gift to be able to live on this planet and to be able to experience life as we know it.
Right.
And I
Especially in the
actually,
West. Yeah.
especially in the West, although I moved back to the East Coast because I happen to like the intensity and
Yeah.
humidity and snow and everything else, right?
Well,
You
I
get
meant
plenty of
Western
snow.
society, but sure.
No,
Okay.
no, I understand what you mean. But like I actually do think that we will solve this and things will be better. But this is an interesting inflection point, and I think that we have unfortunately exhausted many of the tools that we've used, and now we just need to watch the systems play out until we come up with a better one.
Got it. And as those systems play out, I think you would say uh, you know, they're going to play out. So use them to your personal purposes, meaning recruit LeBron for your team if you can, at least for your fiduciary responsibilities, and then maybe use your personal responsibilities to try to be a part of the solution in terms of driving the reforms we'd like to see.
Unfortunately, you just defined the path that I try to follow, and it falls into the category of you feel insane half the time, and you are deeply saddened by the choices that we're making as a society. But we've known since Adam Smith that, price is the mechanism of information exchange in a market-based economy. It's how we are supposed to convey information. If we suspend the information content in pricing and we continue to apply the rules of capitalism, you're going to end up with an incredibly rapacious and extractive system. I don't think socialism is the right answer. I do think that more regulation around behaviors and antisocial behaviors in capitalism is ultimately going to be the answer, but we're not ready to embrace that yet.
All right. Well, look, we'll end it there. So your parting, sort of investing advice to people, as I took away, Mike, is hold your nose, recruit the LeBron James of the giant mindless robot onto your side while it's still working the way that it is. DIY investors can figure that out on their own as best as they can. Folks that would like to get a good financial quarterback to help them could go to could go to your business and perhaps look at investing in some of your funds. So if they wanted to do that, where should they go?
You can go to www.simplify.us if you are interested in our funds. If you're interested in my thoughts or writing, and I can't imagine why you would after this interview, but
They would be.
you can find me on X as @profplum99, and I have a Substack called yesigiveafig.com that is available at a very low cost. I only charge for it because I want to make sure that people value it rather than simply occupying their email. If you do not want to pay, but you do want to read, I'm more than happy to extend subscriptions. Just send me a message.
Okay. And I will say, as somebody who subscribes, Mike is a great writer. And if you really want to understand some of the concepts that he and I have talked about here in depth, he's got lots written on them at that site. All right, Mike, as usual, just a fantastic, intellectually challenging, kind of depressing, but practical and realistic discussion. So thank you.
Thank you. I appreciate it, Adam.
All right, well, now's the time in the program we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. I'm joined as usual by lead partners Mike Preston and John Lodra. Guys, great to see you. John, why don't we start with you? Because I think you've got a couple of dots to connect with us, both with Mike Green's analysis, but also with GMOs. I just interviewed John Thorndike of GMO on this channel right before this video. So why don't we start with your insights from that, and then we'll just we'll talk about what the markets have been up to this week. Some interesting things going on, especially in the precious metal space.
Yeah, great to be with you, Adam, and always enjoy Mike's comment. He's certainly intellectual and pragmatic about the realities of modern markets, and we listen to a lot of what he has to say, and it's very relevant. You had related the interview you just did with John Thorndike, I think it was from GMO. And ironically enough, I was at GMO's annual investment conference in Boston last week. It was a 2-day conference. People from all over the world tune in virtually, but being that it's in essentially our front yard, I went in and joined about a couple of hundred other people for a 2-day, pretty in-depth investment conference, touched upon a wide range of things. And, kind of connecting the dots to the conversation you just had with Mike, the very first session that the GMO team had in the 2-day conference was essentially, I'll paraphrase, it was a reconciliation of their heritage as value investors and mean reverting kind of theorists about markets, and an absolute acknowledgement, even if a reluctant one on their part, that passive flows absolutely are a factor that not only should be monitored, but actually tried to exploit. So they talked about, for example, they've done a lot of work at looking at the fact that, passive rebalancing on a quarterly or monthly basis absolutely has a measurable impact on returns, and that's something that they're trying to exploit. So they went through a whole bunch of stuff. So I found it really interesting. We too, I'd say, are fanboys of Jeremy Grantham's long long heritage in the firm's work, great work over market cycles for many decades. And I think, I walked away from this conference with a signed copy of Jeremy's forthcoming book called The Makings of a Perma Bear, I think is the title. And it's a very apropos because I think he in a nod in the title acknowledges that this cycle has been absolutely extended beyond what the normal kind of traditional mean reverting cycles would have. And we don't think that's invalidated, and it's the almost the predictable result, I guess you could say, of trillions of dollars of horsepower and firepower being unleashed into markets over the last decade and a half that we're still, even though the Fed just last week announced a curtailing of their quantitative tightening, there are still many multiples of reserves and assets on the Fed's balance sheet than prior to the GFC. So this is going to be with us a long time, and these dynamics will be around for a real long time. I'll just give a quick comment about the talk you had with Mike about the private markets. We a long time ago here at New Harbor, made a very conscious decision to not only focus our strategy on tactical responses and proactive movements as relates to markets, but also to place a very high premium on liquidity. What we have learned is, clients that really need their money to live on, as much as they are concerned about good performance and making sure downside is not that dramatic, they really are concerned about being able to get their money when they want their money. And that's all well and good in private assets until you can't. And we're
Right.
seeing that. You and Mike talked at length about the illiquidity phase right now in private. These both private equity and credit are not being able to kind of realize values of their assets on the time frame that their investors are demanding. And even worse, the mark to markets, which are somewhat arbitrary, kind of appraisals, are turning out in some cases to be dramatically away from where the market really is. And he made reference to the home remodeler. It's a company called Renovo, and they went, in a very short period of time from basically a mark of 100 cents on the dollar par for their investments to essentially zero. And there's headlines like BlackRock may, I think BlackRock was one of the firms that was highlighted might have to take a full write-off, and it's obviously just one small piece in their portfolio. But these are real dramatic things. And I want to share one graph because I think this speaks to how pervasive these tentacles go in markets. This is a chart that looks at basically insurance companies' exposure to private credit. And you can see that, first of all, the number of private rated securities held by insurers has ballooned over the years. And you can see, there are all kinds of different flavors of these, but United States and Canadian insurers have a huge allocation to these. This is, I think just in the last couple of weeks, I think UBS's chairman basically said, we're seeing kind of credit rating shopping going on, much like we saw during the housing crisis, where credit agencies were being sought to basically tell issuers what they wanted to hear in terms of the credit rating of the securities. We know all about the AAA tranches of mortgage debt that were basically just a bunch of junk mortgages that didn't deserve AAA, and we're starting to see that in private markets now. So there's a whole lot there, a whole lot more cockroaches we think that could likely come on the scene, and it will have spillover effects, no doubt, into public markets. So those a couple big picture takeaways I wanted to comment, and I'm sure we'll have plenty more to talk about there.
Yeah, well, it's super interesting to see those dots being connected. And so essentially GMO was saying, yeah, Mike Green's onto something here with this passive factor. So, as Mike and I talked about, he's got concerns about the private markets. But let me ask you this, John. So, multiple things can be true at the same time. And, it's palpable talking to Mike Green that he he doesn't like the current environment we're in that is so passive driven, but he has to, as a fiduciary, he has to, basically call the world as he sees it and invest accordingly, right? And so, he generally says, look, I think unless and until something really compromises these passive flows, the bid for the market is going to be pushing it higher over time because of these passive flows. And in particular, the big stocks that are the greatest beneficiaries of these passive flows.
Mhm.
And it's sort of like almost everything else be damned, right? So I'm curious for you guys as capital managers, and especially if there are any key takeaways from the GMO conference on this, is like, what do you do with that? If it's like, if the most important factor is passive flows, do you just, push everything, all your other concerns aside and just ride this thing until you see obvious signs that it's getting compromised? I guess that's question one. Question two is that can be true. You can have the continued rising tide of passive, the passive bid, but you can have periods during that rise where the market actually falls pretty substantially because you have, some big black swan or something that the market didn't expect. The market didn't really know what Trump was going to do with tariffs. It got surprised to the downside with Liberation Day. But as Mike said, then you had a ferocious, rally after that. We might have something similar with private credit, right? Where we might find, hey, there's a lot more cockroaches here than we thought, and that everybody gets spooked, and the market could have a downdraft. But then maybe just to recover quickly again because the passive bid hasn't been fully compromised yet. So, you guys have the challenge of being prudent capital managers, where a lot of people are coming to you who are saying, New Harbor guys, I'm not comfortable with the dynamics in the markets, and I see a lot of weaknesses, and I see a lot of things historically that would have suggested tougher times for the markets ahead. But with this ongoing positive bid, how do you? It's just got to be really tough, I think.
Yeah, it's challenging, and look, as much as we it seems appealing to go out and try to pick individual stocks, value stocks, quality stocks. Our methodology is largely, it's almost entirely based upon ETFs, sector ETFs, geographic ETFs. Slicing the market, but in index form through ETFs. And that's in a not so subtle way, us acknowledging that yeah, these markets are very much driven by flows, not company A versus company B and the earnings report they just put out in a durable way, anyways. But there's also quite a bit of dispersion underneath the surface. Yeah, so you can buy an S&P index fund, and just as it benefits by the passive flows in, it also gets hit by the passive flows out. If certain constituents sell off, so Mike acknowledged that the swift pullback in February and March of earlier this year is absolutely the reverse of the mindless robot, and 2022 is another example of that. So I think the big takeaway there is that as easy as that might seem on the surface to just set it and forget it, you're also likely to see these pretty dramatic swings from time to time that are enough in and of themselves to unnerve people and get them out at the wrong time. So we do think there's a middle ground here to embrace kind of the passive flow, but also be very tactical, whether it's through sector rotation, kind of hedging against these short-term, kind of moves down. And we see that the technical indicators that we follow are essentially different reads on flows. Their momentum, their relative strength indicators, all in their heart, driven by flows. It's not about valuations. It's about where the money is flowing at any given point in time. And for example, all this talk you just had with Mike, I think most people take away, oh, it's just the S&P or just the Mag 7. Well, one of the best performing areas in the stock market this year to date are foreign stocks, international stocks. And I would say that most mindless robots are way under allocated to those. So it's not the only show in town. And our relative strength signals have led us into having the largest proportion of international equities that we've had as a percentage of our total in any time in the last few years. And these are the kinds of things where I think you can reconcile both those realities and still, we think, add value and deliver, good returns, but also very, very mindful about protecting these passive down swells that are absolutely going to happen and oftentimes with little notice.
Okay. And presumably by riding assets like international stock, international value, even to a certain extent, US value, um, they're not trading at the crazy multiples that US growth stocks are. And so if and when there are these drawdowns that you mentioned, um, these other sectors should not get hit as much, right? There's less froth to be taken out of them than there are obviously in some of these other areas.
That generally is a very true statement to make, that and the valuations of most foreign markets are way kinder than the U.S. stock market in general, and that generally historically has been a cushion unto itself. Not to say there's no risk, because when the U.S. market has a downdraft, it usually has follow through effects everywhere. But on a relative basis, yeah, starting with a better valuation is historically been a relatively safer place to be.
To be. All right. And folks, to get a better understanding of kind of the opportunity that these international markets offer, if you haven't watched it yet, watch that interview that I did with John Thorndike from GMO, because he goes into this in a great deal of depth. And actually, you get the you get the benefits from the fundamentals of these companies. You get the benefits of the some of these companies had really been kind of almost left for dead. So, one of the reasons why they performed so well over the past year is they were at throw the baby out with the bathwater prices at the start of this year. But also, you get an additional kind of potential option value in them if the dollar continues to devalue versus the home currencies of these countries. No guarantee what the dollar is going to do going forward, but at least from GMO over the next 5-10 years, they expect the dollar to weaken on a relative basis to other currencies. So that's just another tailwind that they expect on these markets. And again, there's a lot of factors going on here, which is why I would say if you want to learn more about it, go start with that interview with John Thorndike.
And
All right.
one
Yeah,
other
go
thing I
ahead.
want to add, just quickly on this mindless robot. We just we talked about how private equity is a bit of a stuck mode right now. These big institutional investors that kind of pendulum swing way heavy into private equity, I would not be surprised to see kind of the pendulum swim back the other way. Where they start to say, hey, private equity hasn't really been all we thought it was going to be, and private credit, we're going to go back into public markets, and this is a body, big endowments and pensions, more or less, they still have a very, disciplined investment mandate. They're not going to just plow into the S&P 500. So I think there could very well be, through that factor, a more price sensitive buyer coming into markets that in some small way kind of offsets some of the mindless robots. These are all big picture tectonic shifts, but I would not be surprised to see that pendulum swing back in that direction.
Well, I will hope you're right. I share some of the concerns that Mike mentioned of there's a real push now to make alternative investments more available at least to the retail market. And the skeptics, which I will include myself in at times, thinks that this just might be sort of a backdoor way to get these private funds to be able to dump a lot of their junk on the unsuspecting retail public. And as Mike mentioned, that one of the concerns about this is, we're starting to hear a lot of kind of longstanding Wall Street brands recommend that people start thinking about moving some of the 40% in the traditional 60-40 stock bond portfolio into alternative assets. And I think that could be a really good thing for well-informed investors. And I think, you guys and I think that especially things like precious metals probably would benefit the average investor to have a little bit more exposure to them, because right now the average investor essentially has zero exposure. But as Mike was saying, it's basically adding more equity to the overall equity exposure to the average investor, probably both retail and institutional, by these new endeavors. And that's a little bit nerve-wracking, right?
Yeah.
Because it's all about risk return. And if you're not swapping public equity with private equity, you're simply adding private equity to public equity, you really are increasing the overall risk exposure to the general portfolio.
Yeah, Adam, we could go on a whole separate topic on the invitation, encouragement of retail to democratize assets to accounts to these assets. I did a video on that on our own channel, but we're pretty skeptical. In fact, we get all kinds of product pitches through our doors. We're very selective at who we listen to, but there's a whole cadre of vehicles out there offering democratized assets to things like private equity, and they're in things that for example, deal in secondaries, which is code for, hey, these big guys went out, they can't get out, but here's a vehicle where they can essentially get out by pawning it off on the small retail investor.
Right.
So buyer beware for sure in those areas.
Yeah. All right. Well, look, Mike Preston, thanks for being patient here. We'll come over to you now. Feel free to add anything to what John and I have just discussed here. I want to ask you about precious metals in just a moment here, but I guess on the topic either of the giant mindless. Well, let me ask you this: on the giant mindless robot, one of the things that could really impair these capital flows, these passive capital flows, is a material reduction in the workforce. Right, a huge part of the passive bid is the mandatory purchasing every month of the retirement account funds that corporate America manages, right? And so if there's less people working, those funds that get invested every month are going to start going down, and that's something that could really impact negatively the passive bid. Unemployment is still, as best we can tell, without the latest data because of the government shutdown, but unemployment is still relatively low. But we are seeing, more and more signs that companies are certainly not hiring. We're seeing some pretty large layoff announcements by a lot of companies these days, more and more the world, I think, is beginning to kind of get the memo that AI could be a big jobs killer. So my question here, Mike, is there a chance in 2006 that we actually see enough shrinkage of the workforce that it could actually make a material impact on the passive bid?
I'm not really sure, Adam, to be honest, because I don't think the unemployment rate changes that quickly. I can imagine. I guess we have to look back at a chart to see how the unemployment rate changes over time. And I know it's hooking up slightly here over the last
when
6
it hooks
months.
up, historically, when it hooks up, it does spike.
Yeah, and the SOM indicator triggered, I think, a year ago. It was one of the few times, maybe the only time the SOM indicator failed to predict a recession. But yeah, so it's been hooking up for a while. The question is, how fast can it move? And if it does move faster, how impactful is it going to be? I don't really know, because I am not so sure that I 100% agree that that is the thesis that we're working with here. I have to agree that the mindless robot, the passive flows, has exacerbated this bubble more than I think any of us thought possible. We've been public about that. GMO's been public about that. Managers like John Hussman's been public about that. Yet, I believe that Mike Green was talking about a new regime, basically an expansion, a mean expansion versus a mean reversion.
Yes.
GMO thinks there's going to be a mean reversion. New Harbor thinks there's going to be a mean reversion. Mike Green doesn't think there will be. So you got to have to pick your poison here. You asked a question about how to manage money when you've got this giant mindless robot. Well, you've got to do your best, because we here at New Harbor are fiduciaries as well, right? Just like Mike Green. And so we have to try to navigate that. How do we do it? Well, we put some governors in, frankly. We've got 45% equity instead of 80 or 90. And we've got hedges around that 45%. What does that mean in a straight up bubble market? It means possible underperformance. We accept that. That's the decision I'm talking about. You make a decision. You pick a side and you make a decision to underperform if that happens. That's the price of being more agile and nimble. We have our options, which are also good, but not perfect. But we are definitely in the mean reversion camp. We've said many times that we think we're approaching the crisis point of this fourth turning cycle. It's followed by a climax. If you really buy into that whole theory, it's hard to imagine that we're going to go through crisis slash climax of a fourth turning, probably in the next 5 years without a major collapse in the market. So I think that we are going to have that mean reversion, and so everything we do has that in mind. To answer your question, do I think that unemployment could go up fast enough to trigger this? Yeah, I really have no idea. I don't know. I think we're going to have some kind of catalyst. History has shown that other major market tops can top without major catalyst. 1929 didn't really have one, as far as we can tell from history, and maybe this one won't either. But for all I know, we're already in a recession. We could be. The data's been pretty muddy, and everything's been kind of shades of gray now with constant intervention. One thing that Mike talked about is the bailout environment. Everyone expects it now. And it will almost certainly be what the government does again at the first sign of trouble. And so therefore, it seems like we can float along with negative data longer than we ever could have in the past. So that's kind of my take on that.
All right. I just want to show this real quick, just to show what I was talking about historically. So here's a chart. Red is the federal funds effective rate, right? This is the discount rate that the Fed sets. And then the blue is unemployment. And the gray areas are recessions. And you'll see it almost every recession here on this chart. You had the unemployment rate, trending down after the previous recession, bottoms out, starts heading upwards, and then it spikes up into the next recession. Now, of course, these gray zones, were not declared in real time. They were usually declared, a year or so in arrears. But almost every time here before, going into every recession, you see that you have a stable unemployment rate that had bottomed, slightly started turning up, and then bang, shot up into the recessionary period. So, something has to be different about this time for that not to happen, because you can see we bottomed out here. We're now, it's beginning to pick back up. I should also note too that those recessions not only were concurrent with a spike in the unemployment rate, but almost all of them happened after a period where interest rates had been hiked, held steady for a while, and then the Fed had just started to cut. And that's sort of exactly what we're seeing here too, right? Big hiking regime by the Fed. They held it steady. They cut a little bit, held it steady for a while. Now they're starting to cut again. So you got to have a really good explanation for why it's going to be different this time. And there may be, maybe AI is changing the game. Maybe the giant mindless robot's just going to keep everything going here. Who knows? But, there's a lot of things around the AI trade that are really looking long in the tooth as well here. We're starting to see things. I just saw an article yesterday about Oracle, where Barclays just downgraded Oracle's debt to sell, because it's saying, look, given what Oracle has you remember when Oracle stock, like a month ago or a couple of weeks ago after their earnings call, this massive, big, kind of relatively stodgy blue chip tech company added like 30 or 40% more market value within like half an hour after its earnings call, because it basically said we're finally getting into the AI game. What Oracle has now said they're going to need to spend to be able to realize that potential future value. Barclays is looking at, and they're saying like they're going to run out of funds before that. They just don't have enough money. They don't have the ability to raise enough money to actually spend all that. So, you're starting to see, I guess people beginning to doubt that the AI trade is going to unfold as completely as the market has been expecting so far. In a near-term time frame. So who knows what's going to happen with all that? But that again is something that could puncture the euphoria of the market. We'll put it that way. Mike, you're nodding a lot as I'm saying this.
Yeah, Mike talked a lot about that. There's been a lot of hype in AI, and it's still unclear as to how impactful that's going to be in the real world. It is transformative. I use it. It's talked to a lot of people in business that use it. It is a wonderful thing. And I don't think that we understand exactly how that's going to matter to jobs, to stock prices, et cetera. Mike Green talked about low margins, negative profits, massive CapEx, huge debt. That's It's a recipe for disappointment if anything goes wrong. And over the last 2 weeks, a number of these names have been knocked down. So this, particularly the last week, has been kind of like the anti-AI trade week. But it's still really early with so many of these names. I mean, Palantir is up around, I think, 180. I remember a couple quarters ago, we broke through 120, had massive price to sales, and the metrics were just off the charts. And then the stock almost doubled from there. Now it's about 50% higher than where it was. And the market is, Palantir is struggling to make new highs here, but it's a big name in the AI space that everyone mentions as one of the behemoths in the AI space. So, but there's so many other small speculative ones that are not turning a profit that really you're just taking a flyer on. And probably not really worth it for most investors to concentrate in that area unless they're just absolutely, spending most of their time researching it. And because there's a lot of hype there. Absolutely, there's a lot of hype there.
Well, here's a question, and then John, I'll come back to you for the precious metals and we'll wind things up. But here's one thing I don't get about AI, which is personally, I've mentioned many times in this program, I just don't see how AI is not going to be a massive jobs killer if it's anywhere near as impactful as we currently think it may be. And given that, I just wonder, why don't we start with that as the assumption as a country, right? Hey, this thing is going to displace a ton of people. Let's figure out how to mitigate the impact of that rather than just displacing a whole bunch of people and then trying to figure out what to do, right? So I don't understand why as a nation, we're not saying AI has to prove to us that it's not going to be a jobs killer. Let's start with the assumption, kind of almost like a guilty until proven innocent approach. Just because if I'm correct, and we displace millions of people that we don't really know what they're going to go to next because we're not creating a lot of new jobs. In fact, we're getting rid of an increasing number of jobs. We could create a massive sort of social underemployment problem. Yeah, I mean, I just wonder why we as a society don't say, okay, look, if it could be that bad, and it looks like it could be, then let's find an approach to go pursue this in a way that hopefully, doesn't do that or doesn't do that as to the scale that it could if we're not paying attention. Why is our default? We're just not going to pay attention and we'll deal with the problem if and when it arrives. Do you have any thought on that, Mike?
Just that's the way we always do things. I mean, we just show me an example where we have been proactive when it comes to an economic problem. We don't. We wait for blowups to happen and then we patch them over. So I don't really see that being the case. I don't think there's any chance of that happening. But I'm with you. I think a lot of jobs are going to be lost, and I don't know if it's only going to be AI or whether it's going to be a collapse in the stock market that really starts it off, and then it's worsened by AI.
Yeah.
So I don't even know how you do it.
I worry about the job losses of a moderate or larger recession, but if it was a garden variety recession where the economy would reabsorb those people, after a period of time, whatever. That's just the business cycle. I'm much more worried about large scale job displacement where the jobs just don't come back because they've been automated.
Yeah, and I really think that's going to take. I think we know from history that's going to take years, if not decades, to retrain people. Some people close to retirement will just retire early. Bottom line is it ends up, I don't want to be negative, but there's no way out of it that's not painful. And if you tie that into where we are in the market cycle at these obscene, never before seen valuations, with the viewpoint that we will see a move towards the average valuations again, and that'll probably coincide with a crisis slash climax of a fourth turning, then unfortunately my answer is that there's just a lot of pain in all of that with very little chance out of it, in terms of avoiding those jobs losses.
All right. Well, there've been a lot of kind of heavy and kind of depressing conclusions on this, this particular interview so far. So sorry to add one more to the fire there, folks. And wrapping up, John, I'm going to come back to you real quick. I just want to comment on the run we're seeing today in the precious metals. So gold here up almost $90 an ounce so far, back over $4,200 an ounce. I'm talking about gold futures, just FYI to be specific. Silver futures, even bigger day, up over 5%. Silver back over 53, silver futures back over $53 an ounce, actually almost $53.50 an ounce here. So, John, we were cautioning people over the past month that, look, the precious metals had run super far, super fast. You're likely to just get a technical pullback, period, irregardless of the fundamentals of what's going on. And as that pullback that we've had over the past couple of weeks materialized, I think, guys like you and I sort of felt, yeah, pretty validated about that call. But then, of course, the question started arising, which is, okay, well, is the rally over in the precious metals? And maybe was that a blow off top like we saw in 2012 and in 1980? And, after which prices cratered and then were kind of dead for long stretches of time. Still TBD, the script's unfolding here in real time, but we're seeing the metals catch a pretty strong bid here over the past couple of days. Is the rally back on?
Yeah, so let's talk about that. So we have talked in recent weeks how even we, having been, bullish on precious metals for many years, even when they were, seeming like they were dead in the water, we got a little concerned with how quickly they ascended and got overextended. Now, I will say, and I'll look at a chart in a second, but a lot of this is sentiment driven, and even though we saw a perking up in our client base and prospective clients about, hey, let's add more to precious metals, it paled in comparison to, for example, back in 2011, 2012, where you know people were having at home gold parties. Bring your gold jewelry, we'll pay you money for, like, it didn't reach that kind of
Right. All the cash for
mainstream.
gold ads that were
Yeah, I
available. Yeah.
mean, so there's that, right? On a price action basis, we got really extended, but it didn't have the same kind of, like, everybody's in it kind of feel and sentiment that we saw back in the last major peak in 2011, 2012. So that's kind of healthy. In fact, much of the buying, that we've seen in recent years has been central bank buying, really convicted buyers, as a legitimate reserve asset, not just a price, price go higher kind of trade. But let's look at some charts here. This first one is GLD. It's a gold ETF. None of this is recommendation of any securities or anything like that. But this is a daily chart of GLD, and we had this long kind of triangle period here back in kind of the summer that broke out, and we saw a very fast ascension. Right up what's called an upper Bollinger Band. This is two standard deviations above the 50-day moving average, and it can do that for a while. But when it starts to poke above some of these metrics, and if we go out to a weekly, we got way outside the weekly upper Bollinger Band. Rarely in history has that ever happened, and we got way outside. So it was very, and there's a whole bunch of other technical indicators we look at, exhaustion and flows that, we thought it very highly likely we were going to see a pullback, and I'll get into how we managed that in a minute. Silver, same kind of thing, and so what we've seen more recently is we, took out this 21-day moving average, and we kind of started to approach the 50-day moving average, and we kind of had I would say, a healthy little pause here. And yes, we've been sharply moving higher. Too early to say if this is going to stick. In some ways, some might just say we're closing some gaps here, and I would not be surprised to see this kind of consolidate for some weeks or months here, even if the longer term trend is higher. Silver, same kind of thing, maybe just a little bit more, extreme. We had very sharp sell off here, approached the 50-day, and here we are, chasing very close to the prior highs. This is SLV, an ETF that has silver bullion. Now we do, I will say we hold this in our client portfolios, and again, not a recommendation for viewers. This is not personalized investment advice, but we got really concerned with the same kind of blow off here, and we actually sold some call options against this. And the call options originally were a strike price of 41 on this ETF. Now, of course, the stock went way higher, and we didn't chase it. We felt pretty confident, as much as it sucked, kind of leaving this upside off the table. We felt pretty confident it was going to pull back, and when that did, we punched those call options up a couple strikes. So we were able to kind of get a couple more dollars of upside. But right now we're in the money on the call options here in a covered call on SLV. So if we do get a pullback here, that pullback would be rather mooted in our accounts. Just like this flare up, we're not participating in the full move higher today in silver. Our more substantial position in precious metals is and has been through the gold miners. And this is GDX, an ETF that as a proxy for that. Here again, we've got half of this position written with call options that are strike price of 67. We did sell the other half at 85 and book profits in those calls on this pullback. So we're kind of like, we're still kind of hedged here. We've essentially taken some chips off the table. And that's not really a statement about our longer term conviction. It's more just a statement about the near term price action got a little frothy for our liking. We've got many clients, many at our suggestion, that hold precious metals outside of their investment accounts in vaults or safe deposit box or whatever. And many of them have amassed very large positions. Uh, we still are quite constructive longer term for a lot of reasons we'll talk about. But absolutely, we've been telling folks to smartly sell into this strength. You should never hold out as an objective to never sell below a top, because life's about using your money, not just seeing it go to new highs, right? So we've been telling folks to, hey, sell some of those metals you have. Go on that trip you've been talking about. Do the home improvements you've been putting off. This is what it's there for, right? Trading these, sound sources of money, if you will, into real life uses that can make your life better. Um, big picture though, why is, we're seeing a dollar kind of starting to stall here. I had a recent kind of counter trend rally, bullish counter trend rally. We're starting to see that peter out. We may be, gunning for new lows in the dollar. We'll see how that plays out. And that certainly has been a tailwind for precious metals historically and more recently. And we're already starting to see this writing in the wall of new stimulus. The Fed stopped QT effective, December 1st of this year. But already they can't help themselves by saying we may have to start adding assets to, asset purchases again. So the market, I think, is getting ahead of that. There's some headlines about tariff rebates coming in the form of $2,000 stimulus checks to every household below, so gold is basically saying, oh yeah, you're going to do that? Well, guess what? That's going to invite all kinds of problems with inflation and weakening dollar, and that's why you need to have precious metals and things like that, sound money that can be a referendum on those kind of extreme interventions.
Okay. John, do me a favor, pull the silver or gold chart up again here.
Yeah.
So just very technically here for a moment, from a technical analysis standpoint,
This is silver, by the way.
this is silver. This is a great example. Okay, so let's assume for a moment here that this is the top of this latest run, and that silver, starts heading down again. From a technical perspective, would this sort of lower high then make you think that silver, might have tougher days ahead of it?
Yeah, anytime you can't take out a prior high, it's one little vote in favor of, hey, maybe that's all we got here, right? It's not in and of itself this magical indicator. But yeah, if we stall here and can't take out that high, and it just suggests that, hey, the sellers are looking to offload here, and yeah, that would in isolation be a small vote in favor of, hey, maybe we're going to consolidate or go down from here and consolidate these recent gains.
Okay,
But
so how about to the other side then? So
yeah,
let's
and,
say
and by the
punches
same
above.
token, if we take that out, that is in isolation a vote that, hey, the saying is prior resistance becomes new support, right? If we blow through this prior top, that becomes technically new support. It's not quite that simple in life. These part of our beef with technical analysis has been so uh, pedestrianized, if I could use that word, that
Sure.
there's almost too many simple rules here that they don't work out. Sometimes they become self-fulfilling prophecies, but we look at a whole battery of stuff. Things like, however extended are, flows, if this is happening on convicted volume, that means, something different than if it's happening on very light volume, for example, and things like that. We'll
Okay.
look at the dollar trends, a lot of confirming things that will help give strength to the signal one way or the other.
Yeah, it's always multifactorial, but I wanted just to note it because in a week we should kind of know the answer to this question.
Yep.
So we'll revisit it then and see what's going on. And you can tell us then what the other factors are suggesting in addition to what that price action has told us. All right. Well, look, gentlemen, it's been yet another great update from you guys. Thanks so much for joining me after this. Huge thanks to Mike Green for coming on and doing his usual excellent analysis for us. Folks, if you'd like to have Mike Green come on, so let's say perhaps early in 2026, to provide us an update on where things are from his outlook, please let us know that by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. If you would like to get some help in figuring out how to position your portfolio, either for the trends that Mike Green talked with us about, or for some of the trends that the gentlemen here from New Harbor have talked with us about, well, look, I highly recommend you get that professional help from a good professional financial advisor. Importantly, one that takes into account the macro issues that we talk about on this channel. If you've got a good one who's doing that for you, great, stick with them. Don't mess with success. But if you don't, or if you'd just like a second opinion from a good one, perhaps even John and Mike and the team there from New Harbor Financial, then you can fill out the short form over at thoughtfulmoney.com and schedule a consultation with one of the financial advisory firms that Thoughtful Money endorses. It only takes you a couple seconds to fill out that form. These consultations are totally free. There's no commitment to work with these firms. It's just a service they offer to be as helpful as possible as they can be to people. In closing here, Mike, I'll let you have the last words here. I know we're beginning, it's now mid-November, we're beginning to, or the end of the year is coming up fast. So there's things like tax loss harvesting and taking your required minimum distributions if you're above whatever it is, 70 and a half or whatever the current age is, and a few other end of year things that if you're going to do, you got to get them done in the next, month and a half plus, or not plus, but month and a half or less. Beyond making sure that you take care of that stuff, any other bits of parting advice for the audience here, especially given what you're hearing from the folks that are reaching out and calling you guys on a daily basis?
The top 3 or 4 topics are required minimum distributions, gifting, both to charities or to family members, gain loss discussions about capturing losses potentially. Those are the big ones. It's really all about gain loss and about RMDs. Those are the 2 big ones. And so, we're here to talk to people if they want to talk about that, particularly our clients. And even if you're not a client and you got a question about that, let us know and we'll be happy to speak with you. Here we are just about halfway through November, and there's a lot of rumblings about the Santa Claus rally. So don't be surprised if you hear a lot more about that in the media. And that tends to be self-fulfilling. I don't think it can't happen just because it's so obvious. Maybe we are in this phase of a melt up here. We'll see. But that there's going to be a lot of hubbub about Santa Claus rally this year-end rally, particularly if we start to break above these most recent ranges. We're only a hair's breadth off all-time highs. The Dow just made all-time highs yesterday. I think again today. The S&P's maybe 1% or 1 or 2% off all-time highs. So if we break through and start to run, we'll be watching to see if the market broadens out. And then, of course, there'll be all this talk about Santa Claus rally. But we'll actually start to be thinking more cautiously versus more bullishly at that time. So that's kind of what I think about when I think about year-end.
All right. Well, look, thanks so much. Guys, really appreciate it. Another great week. Look forward to being here with you guys a week from now and have you make sense of whatever happens between now and then. But very much appreciate it. John, Mike, look forward to seeing you guys again soon.
Thanks again, Adam. Great to see you. We'll see you next week.
Thank you, Adam, and we'll see you soon.
All right. And everybody else, thanks so much for watching.